Also, in terms of the financial literacy, the comparative analysis is a big piece, and we want to think about it. So, what is the comparative analysis? How does your organization compare to other organizations within the industry, outside that industry? So, and to itself in terms of its performance over the years. So, comparative analysis is really comparing the history and the industry. So, again, ratios and other types of calculations are give you the ability to compare that history, compare it to other players within the industry. Types of analysis, you've got horizontal, which is between 2 years, trend, which is more than 3 years or 3 or more years, vertical analysis of a relationship within a year. And again, it's useful to convert statements to percent of sales just to start to see these trends. It makes life a little bit easier. One key, and I talked about this in the past video, is the compound annual growth rate, CAGR. It is really the idea is a representational figure. It's an imaginary number that describes the average rate at which an investment or other type of quantitative measure is growing, and it's growing at a steady rate according to CAGR. This will be different, and really what it does is smooths out the growth that you see, so it becomes a little bit more easy to understand. But again, it's important to look at both the CAGR and what that actual growth looks like without the smoothing in order to get a better picture of what's going on. With CAGR, you can do it on a variety of different things like investments, profits, sales, customer satisfaction, etc. A comparison from the situational analysis is really the idea that what you're looking at is on the historic side is looking at the liquidity and cash flow, the profitability, the stability, where's the growth, the efficiency. So all of those types of things you looked at within the situational analysis can be moved over and set you up well in terms of here's the numbers I've discovered that seem to make a big difference within the organization that we're looking at, and we start to look at those on a historic and an industry basis. So key items here are really looking at the relationship between debt and equity. So remember a few things here. Debt's cheaper but riskier because it must be paid back and it must be paid interest. Equity is more expensive. It has a price associated with it, which is a lot what students often forget. Equity dilutes shareholder value if you're adding to it. So that becomes a bit of a problem. You're getting rid of the value that some of your early shareholders may have. And equity has implications over control depending upon how it's structured. Industry have norms for levels of debt and equity, and it's good to practice and research those so you've got a little bit of an idea of where they sit. And often this is measured by debt, generally all the long-term debt, over equity in terms of the ratio that you're looking at in terms of to really get an understanding of what's happening with them. In terms of debt considerations, you want to get informed about it. Ask what it can be used for. So what are the debt levels? Can you increase it, decrease it, etc.? Are there covenants? What happens with current versus new debt? Are there restrictions? Are there restrictive or performance covenants based on those? You want to look at the short-term versus long-term. What does it need it for? Are there restrictions on things like lines of credit to operating expenses? And generally there are. And generally lines of credit can only be used for operating expenses. And what assets require, especially within your solution, do those assets that you're purchasing require long-term debt? Sources of debt are things like owners, suppliers, lenders, etc. Equity considerations, is there capacity for equity? Is there room to make some more? And again, you have to think about this also in terms of the sources of equity that you have. Early on, quite often that's friends and family, so that's private. You can have private venture capital, and then things like IPOs and marketplaces. Remember, IPOs are expensive. And I think, again, when students do this, that's one of the things they forget about is the cost of going forward and actually having an IPO. And it may also be expensive in terms of the way that the equity gets structured and have huge implications on control. Equity instruments include things like common shares, different classes of those you have to remember about, voting versus non-voting. Again, varies also in terms of public and private companies. Generally, in public companies, it's harder, or you have less classes of shares. In a private company, you have much more. And then you can look at things like preferred shares. What are the terms? Can they be repurchased or not? What are if there's restrictions? And then looking at items like the retained earnings, shareholders' loans, all of those pieces, and what types of implications do those have on the ability to raise equity. Other considerations you want to look at as you're looking at this comparative things are things like, is the balance sheet messy? What's the flexibility? What's the risk tolerance of the owners of the company? And again, especially with small and family business, tax and estate planning, and succession planning is especially important in things like small family businesses.